Hi, I'm Louis. Genting Malaysia, one of the leading resorts operator in Malaysia. Is it worthy to be invested? Profit and dividend distribution. Between financial year 2012 to 2019, Genting Malaysia's revenue was increasing with time. On the other hand, its profit before tax and profit after tax were fluctuating. In 2020 and 2021, due to the COVID pandemic, Genting Malaysia's casinos and other facilities had to close down temporarily, which led to losses in these 2 years. Likewise, it is shown in this figure that between financial year 2012 to 2019, Genting Malaysia's earning per share was fluctuating, while during the COVID period, the company was making losses. Within the last 10-year period, dividend distribution was consistent. However, the amount of dividend distributed was variable. In the last few years, Genting Malaysia's dividend yield ranged between 1.5 to 6%. In financial year 2021, Genting Malaysia's dividend yield was 3%, which was slightly higher than FD rates. In the last few years, Genting Malaysia's dividend payout ratio mostly ranged between 20 to 80% of the company's net profit. In 2020 and 2021, while the company was losing money, it still rewarded shareholders with certain amounts of dividends. Hence, the dividend payout ratio was shown as negative value. Management efficiency. Between financial year 2012 to 2021, Genting Malaysia's net profit margin mostly ranged between 10 to 20%. In 2020 and 2021, as the company was losing money, so the net profit margin dropped to negative values. In recent years, Genting Malaysia's return on assets and return on equity were fluctuating. Similarly, in 2020 and 2021, as the company was losing money, so both of the return on assets and return on equity dropped to negative values. Stock valuation. Between financial year 2012 to 2021, net tangible assets per share of Genting Malaysia was initially rising but started decreasing since 2016. During this time period, Genting Malaysia's share price has also been showing similar trend. It appears that Genting Malaysia's share price could be linked to the assets value of the company. By comparing its share price and earnings trend, it is shown that there are some correlation between its earnings and share price as well. This shows that the share price is influenced by the company's earnings to some extent. Price to book ratio is calculated by dividing share price with net tangible assets per share. Lower price to book ratio, especially lower than 1, is preferable. This shows that the share price is undervalued and has room for upward movement and worthy to be invested. Recently, Genting Malaysia's price to book ratio has been on a downward trend, indicating that its share price is becoming cheaper over time. Currently, the price to book ratio is at around 1.2 times, which shows that the share price is relatively low in this respect. PE ratio is calculated by dividing share price with earning per share, which shows the ratio between the share price and the earnings of the company. If the ratio is very high, it shows that the share price is at a high point, which is not worthy to be invested. Between financial year 2012 to 2021, the PE ratio of Genting Malaysia mostly ranged between 10 to 25 times. In 2020 and 2021, Genting Malaysia was making losses, hence its PE ratio was shown as negative values. The market cap is calculated by multiplying share price with the number of shares. Hence, higher share price will contribute to increasing market cap and overall valuation of the company. In the last few years, Genting Malaysia's market cap has been on a downward trend, indicating that investors are downgrading their valuation on the stock. By considering the number of shareholders holding the stock, it is shown that between 2012 to 2017, the number of Genting Malaysia's shareholders was mostly constant. On the contrary, from 2018 to 2021, the number of shareholders were increasing, which might be due to lowering share prices that attracted more interest from investors. Financial management and stability. Between financial year 2012 to 2021, it is shown that Genting Malaysia's capital expenditure spending ranged between Rm 500 to 3,000 million ringgit. This spending is used for construction and development works related to Genting resorts in New York and Malaysia. Between financial year 2012 to 2021, it is shown that Genting Malaysia's equity was mostly constant, but its debt level have been increasing over time. In the last few years, its equity to liability ratio was above or close to 1, indicating that its long-term debt is relatively low and its finances stable. Between financial year 2012 to 2021, it is shown that both of Genting Malaysia's current asset and current liability have been mostly constant. In the last few years, its current ratio was above 1, indicating that the company's short-term debt level was relatively low and its finances stable. Between financial year 2012 to 2021, Genting Malaysia's cash flow was between RM2 to 8 billion ringgit, a very large amount indicating that the company's finance is on a stable footing. By considering its cash flow per share, it is shown that in financial year 2021, Genting Malaysia's cash flow per share was RM82 which is around 29% of the current share price. In conclusion, in the last few years, Genting Malaysia has been undergoing major construction and development phases of its various resorts and casinos. Hence, capital expenditure spending is high. As such, its profit have not been increasing significantly despite rising revenue. Furthermore, it suffered major losses during the COVID pandemic. Now that the pandemic is under control and many countries reopening their borders to tourists, Genting Malaysia has a good prospect in returning to profitability soon. In recent years, Genting Malaysia's dividend yield mostly ranged between 1.5 to 6%. Furthermore, Genting Malaysia's market cap is large and its finances is stable. If it is predicted to return to its pre-pandemic profit level of 25 cents per share soon, its PE ratio is estimated to be around 11 times based on its current share price. Do you think it is worthy to be invested in? Genting Malaysia BERHAD is a subsidiary under the Genting BERHAD parent company. Its main business activity is operating casinos, hotels, theme parks and other resort facilities in Malaysia, USA, Bahamas, UK and Egypt. As shown in the figure, the majority of Genting Malaysia's revenue comes from its casino and gaming operations, which makes up 78% of its total revenue. The remaining revenue is contributed by its hotels, food and beverages outlets and so on. In terms of its revenue by geography, it is shown that the majority of Genting Malaysia's revenue comes from its operations in Malaysia, which makes up 41% of its total revenue, followed by USA and Bahamas as well as UK and Egypt, which contribute 33 and 26% respectively. That's all for today. Feel free to share your thoughts in the comment section. See you next time. Bye! The content above is for sharing and reference purpose only. It is not an investment recommendation. Investors are encouraged to carry out further research and analysis as well as follow up latest update information before making any investment decisions.